For decades, for centuries, corporate profitability and the environment have been at opposite ends. It's only recently, in the last 20 to 30 years, that people have started to show more concern about our habitat and our planet. But what was missing was an acceptable way of marrying capitalism with the societal priorities, and then came ESG funds. In the year 2020 alone, 6 new ESG mutual funds have been launched in India. In fact, there are presently 9 ESG themed mutual funds in India, all of which are available for tracking and investment via the ET Money app. While the concept is new here in India, globally the ESG fund flow has seen a tremendous increase from $27 billion in 2016 to over $150 billion in 2019. In this video, we shall get into greater details and understand what are ESG funds, what does it mean to the average investor, how different are ESG funds from other fund categories, and of course, does it make sense to have them in your portfolio? Let's begin. ESG investing is an umbrella term that aims for positive return on investment in addition to creating long-term impact on the society and environment. And for that reason, this style of investing is sometimes called socially responsible investing or sustainable investing. The crux of ESG investing is to evaluate target companies not only on the basis of their financial parameters, but also give due weightage to certain non-financial parameters. These non-financial elements fall into 3 buckets which go by the acronym E, S and G, wherein E stands for environmental, S stands for social as in social responsibility of the company, and G is for governance. The ESG framework thus requires for companies to be evaluated on the basis of positive and negative contributions they make to the society as a whole. So let's probe a little deeper into what these 3 factors constitute. Let's start with E as in environmental. As the name suggests, environmental empathy takes into account factors such as reduction in carbon emissions, a sound waste disposal system, afforestation, and a visible focus on energy and water conservation. Basically, anything that leads to a greener environment. The S part is social, whose factors focus on the well-being of the employees and the society at large. An S-compliant company will take care of employee welfare, gender equality, diversity, pay parity, and would regularly contribute towards relevant social causes. And the final factor is governance with a G. Corporate governance is the core here as it emphasizes on regulatory compliances, grievance redressals, whistleblower policies, ethical conduct, and strong internal controls against wrongdoings. Now, one might say all this is fine and it looks good to put in a report, but how does an E, S and G framework have any links with investing? It's a valid question, and what we found is that a company's sustainable practices are not merely a score, but the viewpoint here is that how a company performs on these non-financial elements actually has a big bearing on the long-term financial performance of that company. Let's take a couple of examples to understand this. Say a company has poor corporate governance, so a low score in the G department. This means this company is more likely to face charges of fraud, whistleblower complaints, and even the wrath of activist shareholders who will want to question every major decision this company makes in the light of its shoddy corporate governance framework. Another example can be in the E category in the form of potential environmental breaches. These can be in the form of release of effluents in the river or other distasteful practices which can lead to fines, penalties, and even closing down of factories. So in some way, you can also look at the ESG framework as a risk mitigant, which can help you identify companies with a lower relative risk score and which hopefully can offer stronger long-term prospects from an ROI perspective. But if you're looking for one investment that comes with super low risk and super high returns on investment, then you don't need to look any further than the ET Money YouTube channel, where we feature 2 highly relevant and actionable videos every week on topics that matter, like investing, mutual funds, and personal finance. So do subscribe to the channel and don't forget to share your favorite videos with your friends and family. While ESG factors are non-financial, they are certainly not non-measurable. The level of compliance to ESG standards are determined with the help of an ESG score that is allotted to companies by research organizations like MSCI, Sustainalytics, and Morningstar. These ESG scores are dynamic in nature and change from time to time as they have to keep pace with the changes in regulations, standards, and the company's green initiatives. Additionally, each of the research organizations have their own scoring methodology. For example, the MSCI has a scale which ranges from triple C, which represents the slow movers, to triple A, which represents the ESG leaders. In fact, MSCI's ESG score is relative, which means a score of triple A or triple B or triple C would mean how well companies have been managing their ESG risk as compared to peers in their industry. In contrast, Morningstar and other research firms have their own rating methodologies. Here's a screen grab from how Morningstar shows the scores for one of India's ESG themed mutual fund schemes. Do notice the detailing here. The scorecard here has an overall sustainability score and a further breakdown of ESG scores for each of the 3 components, that is environmental, social, and governance. One quick note here. In addition to agencies like Morningstar or others, fund houses that invest in ESG compliant companies can also have their own internal qualitative assessments, which can be done by them using their own proprietary tools. This is relevant because these mutual funds can use their own scores to determine which companies make the cut and which don't, which kind of makes the process a lot subjective rather than what it should be. So that's something that all investors should be watchful of. ESG themed mutual funds are categorized as thematic funds, and presently there are 9 such schemes in India. The category in itself is rather new for the country, with a large chunk of these funds having been launched in the last 12 months or so. With regards to ESG scores, the Morningstar India website computes them for every ESG scheme. The table here shows these scores as of February 2021, with numbers varying between 23 and 31. A further analysis of the top holdings show that the preference of most of these funds is mainly towards the large cap companies, and there is also a sector skewness towards the financial and the technology sector. So we have a lot of HDFC, Infosys, TCS, HDFC Bank, and ICICI Bank in this list, but we have to keep in mind that the selection universe of ESG scored companies might not be very big in India. Also, as we said earlier, ESG funds are not as much about what they hold, it's more about the kind of companies that are excluded from these funds. And in line with that thought, ESG fund managers tend to not invest in companies that deal in products and services that are socially and environmentally harmful, or ones that have poor governance practices. Interestingly, a number of these ESG funds also invest in overseas companies that comply with the ESG framework. With regards to performance, it's important to note that ESG funds in India are all actively managed, and there are no index funds available for investment within the category. But while there is no index fund, there does happen to be an index which can be used to benchmark the actively managed funds. The Nifty 100 ESG index is the most followed benchmark for ESG funds in India, and thus it becomes the starting point of our performance analysis. For the purpose of comparison, we start by comparing the Nifty 100 ESG index with 2 related broad market indices, that is the Nifty 50 and the Nifty 100. The last 9 years of data reveals that the Nifty 100 ESG index has never disappointed in terms of performance, and in 6 of the last 9 years has outperformed the Nifty 50 and Nifty 100, even though by a small margin. In fact, a quick check on the difference in performance between the Nifty 100 and Nifty 100 ESG index shows that the difference has largely been within half a percentage point in most years, with the year 2020 being an exception to this pattern. We also did a check on the 9 actively managed funds, but honestly, it was difficult to make any sense of that on the performance front, as the evaluation period of a few short months was grossly inadequate to make any kind of meaningful conclusion. There are many global studies that have shown that companies with a higher ESG score experience a lower cost of capital, exhibit higher returns on equity, give more profits, and by that logic, their stock price appreciates more than non-ESG companies. However, ESG investing in India faces some peculiar problems. For one, we do not have enough ESG compliant companies, especially in the mid and small cap segments, which limits the investable universe of companies. A second developmental issue is the absence of a common set of ESG guidelines. But having said this, in May of this year, the SEBI issued a circular notifying new disclosure norms on sustainability which are applicable to the top 1000 listed companies. We believe this is a move in the right direction, but as it stands, there is no defined framework for ESG compliance in India, which means a lot of it is left to the fund houses who then develop their own internal guidelines. The potential issue with this includes the incorrect or false tagging of a company as environmentally sound, a practice which is also called as greenwashing. In our opinion, ESG in India has just been flagged off, and the business, the investing community is still a few years away from integrating sustainable investing into its mainframe. In light of this, we recommend a wait and watch approach on ESG funds, and perhaps one should consider them only after the category picks up some more experience. And with this, we come to the end of this video. If you are an existing ET Money investor, we sure hope you are enjoying the new home screen our team has put together after sifting through hundreds of customer feedback and interviews. The home screen looks fabulous with smarter and faster navigation and an all-new Learn section that features our most popular blogs and videos. And if you like this presentation, then do subscribe to the ET Money YouTube channel and help us spread the good word by sharing it over WhatsApp, Facebook, and Twitter with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.